Hey, good afternoon, everybody. Welcome back to another episode of Homebrew. I am Rishi.
I'm off, Joe.
Thanks so much for being here. Really appreciate you guys liking and subscribing our videos. Today, we're going to be talking about a really pressing topic as it relates to the cost to buy your home and the money that you borrow to do so.
Yeah, I think that there's a lot going on in the market right now. Inflation, home prices are record high, rates are going up, and that's what we're going to talk about.
Exactly. So what are happening with rates?
Well, the Fed is increasing the rates potentially this year. So, what you expected in 2021 with low rates at, 2.8, 3%, it's going to be much higher this year.
So to add to that, simply what happened was that in January, the Federal Reserve announced to the public that they were going to increase rates about 3 times this year. The general industry believes that they may increase rates actually about 4 times. And a long story short,
it's not 4 times what it is. It's just 4
hikes. Correct.
Okay.
Right. Not 4 multiplied.
Yeah.
But at 4 various moments in the year. Correct.
Yep.
So the Federal Reserve increasing interest rates directly impacts shorter term loans, things like car loans or home equity lines of credit, which some of you might be experiencing already. It is being increased to combat inflation, right? We know that there's inflation in this market. We've printed the most money that we've ever printed in a 2-year period in history. And the prices of things have gone extremely high on all ends, right? So inflation is here. And so this has been announced to combat inflation. And so what happens in this case is the 10-year Treasury rate also goes up. And that is actually what directly ties to the mortgages that consumers like you and I end up having access to. And so when there's inflation, the 10-year goes up. When there's deflation, the 10-year goes down. Interesting.
So the average home buyer, looking to buy a home, 30-year fixed rate, maybe a FHA loan, what should they expect? Like, are they paying more in 2022?
Yeah, unfortunately, that is the case. So if we took a couple of numbers just to break it down for you, if you were trying to buy a home for about $600,000 in December and you were putting down 10%, your rate, assuming that your credit score was strong and, you had a job and, you were able to get underwritten by a lender and you got a rate of about 2.875 at that point, your monthly mortgage would have been $2,240 a month. Now, the same buyer, unfortunately, their rate is somewhere between 3.25% and 3.5%, meaning their monthly mortgage cost would have gone up to $2,350 or around $2,424, which that's sort of an addition of about $100 to $200 a month from what you were expecting to have as a mortgage cost back in December.
Interesting. So, I mean, in the greatest scheme of things, it's not a huge hike, but if a buyer is trying to save money, that's definitely something to consider.
Yeah, a lot of our generation's been used to very low interest rates, right? The last 10 years have been extremely low interest rates for us, even before COVID. And so our parents' generation might know about double-digit interest rates, for example. We've been fortunate enough to see like historically low rates. So even if they're going up into the 3s and even if they hit 4, for example, yes, it's going to cost you more money, but just remember, it could be worse.
Interesting. So if you look at the market, does that mean as interest rates go up, there's more supply that's entering the market because sellers want to kind of offload their property?
Right. So you're leading up to a good point in that if interest rates go up and the cost to borrow goes up as a buyer, the buyer pool is going to have less money to bring to the table, right? So in effect, just like we're trying to combat inflation, if home prices have inflated, they should deflate a bit. And so if there have been sellers who've been on the sidelines over the last 2 years who've been wanting to sell but haven't actually pulled the trigger because we've seen some of the lowest inventories of homes come to the market, one would think that now home inventory should increase and sellers should wake up and decide to sell because they think they don't want to miss out on getting top dollar like they've been getting for the last year.
That's interesting. So in theory, there's going to be more inventory. Sellers are incentivized to kind of put the homes in the market. And on the flip side, buyers, again, rates are still historical lows. They should, want to buy because rates are low, but there's more inventory in the market.
Yeah.
So potential, lower cost.
So this should lead to a net positive in my belief. Like you should have more options as to the homes you're looking for. You shouldn't have as many competitive bid situations. Yes, you will have higher interest rates, but I think at the end of the day, you'll be a happier buyer with the positives that come out of this.
But talking out loud, how does this kind of like play out? Does it happen instant? You see this kind of, taking effect in the market, or, it's going to take some time?
Yeah. So if you look at a chart of the 10-year Treasury rate, you can see there's been a big blip basically in the month of January.
Okay.
And so we're feeling it, even with our clients today. We're seeing that their rates have gone up. It's going to be based on how that 10-year sort of functions throughout this year. But if we're going to expect 3 to 4 rate hikes from the Fed Reserve, I would guess that we are likely going to reach 4% sort of, range by the end of the year. Now, here's a couple of things that you can do to protect yourself from this,
Sure.
right? So, number one, continue to work on your credit score and make sure that it's as high as it can be. That will always improve your ability to get a better interest rate than otherwise. Number two, if you think you can make a larger down payment than what you've been considering doing, that should also help your interest rate situation. And lastly, I would think about the home you're buying and sort of what your intentions are with it. If it's not your forever home and you don't intend on living in it for more than 10 years or so, you may want to consider adjustable rate mortgages. And adjustable rate mortgages are simply shorter term. And the market right now is basically pricing them at 2.5% for a 7-year adjustable rate mortgage and 2.75 for a 10-year adjustable rate mortgage, which are still extremely low. And the reason we bring that up is if you're not going to be living in this home forever, whether we are in a higher interest rate climate or not, you should still follow this rule of probably really consider, a shorter term loan, because you're going to pay more for a longer term loan anyways. And you're going to pay a higher interest rate because basically you're getting, you're buying certainty, right? When you're taking a shorter term loan, you're buying less certainty. And so in this case, where, rates are just generally going up, this might actually save you money as well as, down the line, you might have some savings from it.
Interesting. So the bottom line, don't panic.
Yeah.
Right. There's options. Still work on your credit, put more money down if you can. Talk to your lender about these other options of loan types and products, and, work with your agent.
Yeah, exactly.
Yeah.
Yep. I think keep a track of where the rates are going, continue to follow the 10-year Treasury rate, and keep in touch with your lender. And if you have been on the sidelines for the last year and thinking about buying a home, you should strongly consider it. We think prices should start to stabilize this year with rates going up, and so that'll help. And we think supply will open up as well. So all, good news on that side of things.